Welcome to the Deep Dive. We're here to pull out the key insights from complex topics and get you up to speed fast.
And today, we're stepping into the world of ceramics and tiles. It might seem mundane, but it's surprisingly dynamic.
Absolutely. It really reflects these bigger shifts in the economy, how we build things.
Definitely. You can learn a lot about what's going on just by looking at this industry.
And that's our mission today. To give you that shortcut, we're diving deep into Kajaria Ceramics Limited's Q1 FY26 results.
A big player in India.
Exactly. We're looking at their financials, their big strategic changes. We've gone through their earnings call, the investor release, the financials,
All the good stuff.
to pull out those crucial bits, those aha moments for you without the overwhelm. And there were some surprising things in there.
Yeah, the headline story is, well, a bit counterintuitive, isn't it? Revenue dipped slightly, but their profitability,
Yeah.
that jumped quite a bit.
Right. And it wasn't just luck. It seems like it was down to some pretty bold internal moves they made, even though the market itself is, well, a bit soft right now. Okay, so let's kick off with those main numbers. Q1 FY26 consolidated revenue came in at 1,104 crores.
Right, which, as you said, was down about 1% compared to the same quarter last year.
So why the dip? The company pointed to a couple of things mainly. Low growth in tile sales volume,
Which is key for them.
and also the drop in ply sales because, well, they shut down that whole division.
Yeah, we'll get into that decision later. But here's where it gets interesting. Despite that revenue softness, their margins actually went up quite nicely, in fact, to 16.72% in Q1 this year from 15% in Q1 last year.
That's a significant improvement, and that obviously boosted the profit numbers.
It did. Consolidated profit after tax, the PT, was up 21%, landed at 108.98 crores compared to about 90 crores last year.
Wow, 21% growth in profit on slightly lower revenue.
And EBITDA saw good growth too, up 11% to around 185 crores.
So the big question then is, how? How do they manage that? Better profits when sales were, a bit sluggish.
Well, that's kind of the core of their story this quarter. They basically said it comes down to a real intense focus on cutting costs,
Okay.
optimizing their people, their human resources, and a whole bunch of other corrective actions they've been taking. It points to a real shift in how they're running things.
Okay, let's dig into that shift then. This unification strategy sounds like a big deal. Historically, they had things quite separate, didn't they?
Yeah, that's right. They had different marketing teams, different channels. One for ceramic wall and floor tiles, another for their vitrified tiles, the polished and glazed ones.
But they noticed something changing in the market.
Exactly. They basically said the difference between ceramic and vitrified tiles had become, quote, marginally best.
Meaning, not much difference anymore.
Pretty much. Especially as vitrified tiles got bigger, you could use them on floors, just like ceramics. The lines just blurred. They were becoming, almost interchangeable for a lot of uses.
So why make the change now? Was there a trigger?
Well, apparently this discussion had been going on for a while, but they mentioned a headache quarter that was Q4 of the last financial year, where they actually posted a loss. And apparently the CFO was really pushing for this change. It just didn't make sense anymore to have these separate teams for products that were becoming so similar.
So the solution, bring it all together.
Yep. They're in the process now of integrating all three tile divisions, one single unified marketing channel, one team.
And the goal is?
Efficiency, obviously, scale. They think unified teams will drive volume. Plus, for customers, it's better, right? One distribution network shows the whole range.
Makes sense. Easier for everyone.
And operationally, it's about being more agile, streamlining how they use resources, cutting costs, and just reacting faster to what the market and customers want.
Okay, let's unpack this. Moving from 3 teams to just one. That sounds like a massive, massive task.
Oh, it absolutely is.
What's fascinating is that they're pushing ahead with it, even saying it might have contributed to the muted sales volume this quarter.
Right. And that really brings up a key question, doesn't it? How does a company balance that immediate market pressure, maybe even a slight dip in sales, with a huge long-term strategic change like this?
Yeah.
It shows they're really committed to this restructuring. They clearly believe it's going to pay off big time in efficiency and market share later on, even if there's some short-term pain.
So how is it going so far? They started rolling it out in Q1.
Yeah, in some states. And they said the feedback has been encouraging. They did acknowledge, like you said, that sales volume was muted, partly because of the market, but also partly because people were adapting to this new strategy.
Understandable.
But they seem confident that once it's fully adopted, they'll have a much leaner, more efficient organization. Lean and thin, I think, was the phrase they used.
And the dealers. What do they think?
Apparently, they're very happy, especially the ones in smaller areas, Easier to deal with one person instead of three.
Yeah, I can see that.
For the bigger dealers, they might send two people initially just to manage the transition, but the goal is simplification.
What about things like showrooms?
Yeah.
Does this mean less shelf space for their products?
That was a concern raised, but no, they're actually optimizing their showrooms too. Instead
Yeah.
of maybe having three smaller ones in a big city like Mumbai,
Uh,
they're moving towards single, larger experience centers like they're doing in Mumbai and Benares. And shelf space overall for dealers hasn't gone down. They said it's actually up 50 to 100% in the last couple of years.
how's that?
Because dealers are expanding their own stores or opening new ones specifically to showcase the wider range they can now offer easily through this unified approach. So it's actually enabling broader display.
Okay, so the unification is one big piece of the puzzle.
Yeah.
But you mentioned intense cost focus driving that profitability jump.
Yes, and this is where it gets really interesting. They talked about optimizing human resources, which involved, quote, letting go of some people. Standard efficiency drive stuff, maybe.
But then there was something else.
But then the really striking move that the promoters themselves, the owners, are not taking any salary this year.
Wow. Okay.
Yeah.
That's a statement.
It really is. You don't see that very often. And it immediately raises questions, right? Like, how sustainable is all this cost cutting? But also, how powerfully does it signal their commitment?
Definitely sends a message. Did they say when they might start taking a salary again?
Yeah, they tied it to a specific target. Only when the company hits a 4-digit EBITDA figure. That means 1,000 crore annual run rate, or 250 crores per quarter.
Compared to what now? About 185.
Yeah, around 187 crores this quarter. So it's a significant jump they're aiming for before they reward themselves. It's that whole charity begins at home idea, setting the tone from the absolute top.
It certainly sounds like they're building a truly lean operation, making some tough calls.
Absolutely. And you see it reflected elsewhere too, like in their other expenses.
Right, you mentioned those dropped quite a bit.
Significantly. Consolidated, they were about 113 crores in Q1. Compare that to Q4 last year, which was almost 167 crores.
Big difference.
And even Q1 last year was higher, around 119 crores.
So what drove that big drop from Q4 especially?
A couple of specific things helped. Q4 had about 22 crores in bad debt write-offs, mostly linked to that plywood business they closed and some UK operations. That was only 4 crores in Q1.
Okay, so a big chunk was cleaning up old issues.
Exactly. And there was also a 5 crore loss on selling some old machinery in Q4 that didn't repeat. But beyond those, they also cut down on travel costs, advertising spend.
Advertising. How are they managing that? Cutting back but still trying to grow.
They described it as a very strategic and focused approach, basically targeting Tier 2 and Tier 3 cities more efficiently to gain market share there without just throwing money at it.
And do they think they can keep these other expenses low, around that 110, 120 crore mark?
They seem to think so, yes. They indicated that run rate feels sustainable. It suggests this isn't just a one-quarter blip. It's a new baseline they're aiming for, a real focus on scrutinizing every cost.
And are there more cost savings coming?
They suggested yes. They're still working on things like reducing the cost of packing boxes, materials, renegotiating with their outsourcing partners, looking hard at raw material prices. So the benefits might continue to trickle through in the next few quarters. It's pretty comprehensive. Looking beyond the core tile business, how a company manages its whole portfolio, that tells you a lot.
Like deciding what to keep, what to grow, what to cut loose.
Exactly. Often companies hang on to things too long. But Kajaria seems pretty pragmatic here. They've shown they're willing to shut down divisions that aren't working.
Like the plywood business.
Right. And scale back internationally where it's tough. It points to a real focus on capital efficiency, sticking to their core strength.
So it's definitely a bit of a mixed bag across the different parts of the business, isn't it? Let's talk plywood first. That's completely gone now.
Yep, closed. It was a wholly owned subsidiary, run on an outsourcing model. They shut it down, basically, because it didn't fit strategically and kept losing money.
And the costs related to that are mostly finished.
Seems like it. In Q1, the expenses from discontinued operations, mainly plywood, were only 2.25 crores. That's way down from nearly 31 crores in Q4 last year. So yeah, it looks like those losses are largely squared off.
Okay, good. Getting rid of that drag. What about bathware and sanitary ware? That's in their other business segment.
Correct. That segment brought in about 91.5 crores in revenue in Q1. And they have big ambitions here, aiming for 480 crores this full financial year.
Up from 400 last year.
Right. Now, they admitted the bathware division actually lost money last year.
Ouch.
But they sounded confident it'll definitely be profitable this year. Q1 sales were pretty flat, though. The main challenge there seems to be getting sales volume up to cover the current costs, which they acknowledge are high.
Are the plants running well?
Utilization looks okay. The Sandier plants in Morby were at 80% and 66%. 66% one is newer. For high-end stuff, just started in March, so they expect that to turn profitable this year. And the Fawcett plant was running at 84%. So capacity is there.
Okay. Now, adhesives, you mentioned, that looks like a growth area.
Definitely. The numbers are smaller right now, 15.24 crores revenue in Q1, but look at the target, 120 crores for the full year.
That's a big jump from 75 crores last year.
Huge jump. And the margins are decent too, around 17% EBITDA currently. They're really investing here. A new plant in Rajasthan just started in May.
Okay.
And another one's coming up in Tamil Nadu in the next few months to serve the South. Right now, they're focused just on tile adhesives, grouts, different variants. It's a clear area of focus for growth.
Interesting. What about their international efforts? They had ventures in the UAE and UK.
They did. Through Kajaria International DMCC, the idea was global expansion. But the UK operations are being scaled down significantly.
Oh, why is that?
Basically, very high cost to run the showrooms there, and they just couldn't see a path to profitability in the short or medium term. So again, that pragmatic decision, cut your losses. If it's not working, they're in the process of closing it down.
Okay. And the Nepal JV Kajaria Ramesh tiles?
Right, KRTL. That's a 50-50 joint venture. It's got a capacity of about 5 million square meters a year, started operations last September.
How's it doing?
It ran at about 69% capacity in Q1, but they don't consolidate the volume because it's only a 50% stake right now. Profitability is, well, they said it's difficult to say.
Yeah.
Low volume, inventory buildup. Optically, there might be a small profit, but management doesn't consider it, robust. They aren't giving any guidance on it.
Is that 50-50 structure going to change?
Possibly. They mentioned a resolution has been passed to increase their stake to 51%, but it hasn't actually happened yet. If they do that, then they'd likely start consolidating the volume in their main numbers.
Got it. And one last thing on the portfolio, that economy brand, Karanite.
Ah, yes, Karanite. That's been discontinued. It was basically a test. Didn't work out too well. And they feel the new unification strategy kind of solves the problem Karanite was trying to address anyway, so another cleanup move. So you put all this together, the internal restructuring, the cost cuts, the portfolio changes, and then you look outside. How do they navigate this tricky market?
Yeah, it sounds like a real tightrope block, doesn't it?
Right.
Fixing the inside while the outside is still, well, challenging.
Exactly. And they were pretty frank about the domestic market. Still muted.
Not much growth happening.
Apparently not. They mentioned customer footfall in showrooms is very, very less. And it's not just tiles. Seems like many building material sectors, paints, plywood, etc., are seeing slow growth, a broader demand issue.
But they are optimistic about things picking up later.
They are. They pointed to two potential drivers. One, a recovery in exports.
How are exports doing?
They took a hit last year.
Yeah.
Dropped from 20,000 crores industry-wide in FY24 down to 16,000 crores in FY25. High freight costs, issues in the Middle East, the Red Sea conflict, all that hurt.
And the outlook for this year?
They're expecting a rebound, maybe back to 18,000 or even 20,000 crores for the industry. The first 3 months were apparently around 4,500 crores, so that's tracking better.
Okay, exports is one factor. What's the other?
Government spending. They expect infrastructure spending to pick up now that the elections are over. It was apparently quite muted last year.
Right. That makes sense. What about pricing in the market? Are they raising prices?
It's interesting. They noted some competitors, especially Morby-based players, have announced price hikes, but they're not actually happening on the ground, according to Kajaria. People aren't paying the higher prices. So Kajaria's strategy right now isn't to push for price increases.
What is it then?
Gain market share, focus on volume, be patient, let the cost-cutting benefits flow through, rather than trying to force prices up in a weak market. And that really speaks to their whole capital strategy, doesn't it? It's disciplined. No new capacity this year.
Right. They specifically said that. No new plants.
Focus on using the capacity they already have, selling off inventory, which also helps working capital, and being willing to return cash to shareholders. It's very much smart growth, not just growth for growth's sake.
They mentioned competition expanding, like Shimpolo in the south.
Yeah, they acknowledge that. Kajaria has a plant there too, so they're competing. But they had an interesting comment about Inframarket.
Oh.
They see them more as an aggregator, not really a real tile player, in the same way they view companies like Simplo or Vithar. A bit of competitive positioning there.
And government orders. You mentioned infrastructure spending.
Yeah, their share of government orders has actually ticked up from about 4% of sales to 6%, and they expect that to grow further. So that's a positive trend.
So capital allocation, they're sitting on cash.
A good amount. Close to 500 crores, they said.
And CapEx plans are modest.
Relatively. Around 150 crores planned for this year, mostly for a new office and just regular maintenance stuff. Like we said, crucially, no new capacity. Growth has to come from sweating the existing assets and selling down inventory.
And potentially more dividends.
They floated that idea. The finance team is open to it if no major investments pop up. Might even propose increasing the dividend policy to the board.
Any big acquisitions planned?
Doesn't sound like it. They said they're not looking for any big thing there. Seems like the focus is consolidation, optimization, and careful growth right now. Hashtag tag outro.
Okay, so wrapping this up, Kajaria's Q1 FY26 really feels like a quarter defined by this major internal transformation happening almost quietly beneath the surface.
Yeah, it's that dual story, isn't it? On one hand, they're dealing with a pretty sluggish market. On the other, they're aggressively reshaping the company, unifying divisions, cutting costs, trying to build something leaner, more agile, and ultimately more profitable for the future.
The key things that stand out are definitely that unification strategy.
A huge undertaking.
The really decisive cost-cutting, especially that promoter salary decision.
Powerful signal.
And this very focused approach to growth, doubling down on areas like adhesives, while being willing to cut loose things like plywood or scale back in the UK.
Yeah, it's a strategic reset, really, trying to get fit and focused in a tough environment. It could definitely be a playbook others might look at.
It's a fascinating strategy, isn't it? You know, in an industry that people might see as quite traditional, maybe even a bit slow-moving.
Right.
Kajaria is making this big bet on internal agility, on discipline, to handle these external pressures. So here's a final thought for you to consider. How might this lean and thin model, driven by such decisive leadership, actually serve as a kind of blueprint for other companies in mature industries, especially those trying to find a new competitive edge when the economic winds aren't exactly favorable?